now is that we are seeing less inflation in the system. And if you are real rates minded, that is, you look at nominal rates minus inflation, then the real rate will naturally climb. And if you believe that the real rate is the major rate that controls what's happening in the economy, policy is becoming increasingly tighter without Fed cuts. And this is in some ways the most important question, Tom, because at this point, there doesn't appear to be any evidence that the Fed should be cutting. And yet they've told us that they will begin an easing cycle later this year, and so have other central banks. And the question is, are they doing this to target the real rate? Or do they actually think the economy will slow and this isn't just a technical adjustment? I think they're going to try to continue this soft landing narrative and say we're real rates folks. My take, of course, Tom and Paul, as you know, is that the economy will slow materially later this year. Not yet, but certainly later this year.
Okay, so that's exactly where I wanted to go, Francis. In reading your research, you've been consistent, concerned about the U.S. economy, bearish on the U.S. economy, perhaps, as you suggest. When you get data today with like personal income, personal spending, when you get the jobs data, does that dent your cautiousness about the U.S. economy at all?
On balance, I am a little bit worried about the math. When are the 2 quarters of negative GDP going to arise? Because that, of course, would be what would qualify as a U.S. recession. However, there is almost nothing happening right now that didn't happen immediately before recessions throughout history. So much of what we hear is how this time is different and the models are broken, and there are certainly things that are different. There are elements that are different. But we saw very strong growth prior to every recession that's come through. It has always been, on average, 2 years from rate hike starting to its impact on the economy, which is sometime in the next 6 months. We have always seen a surge in soft landing arguments right before, and markets are strong prior to recessions. So there is no data now that tells me, I need to be less concerned that very typical economic relationships, like when things cost more, you spend less. I can't throw those out the window, even though I can agree that some things are different. But yes, the timing of this is, of course, the really big challenge. And the timing is complicated by Washington and fiscal spending that's coming through. But I'll just add one thing here. The U.S., of course, not in a recession, but most of the G7 is near or in a technical recession. Japan, UK, Germany, and France are very close. They're kind of coming off on decimal points. So the whole recession or no recession call, first of all, far too binary, but also a U.S. versus rest of the world call. And for most investors, I think that trade is far more important than are we going to get 2 quarters of negative GDP, which, yes, I think we will, but I think that's less important.
How unusual. I'm glad you called out kind of the U.S., what some people will call economic exceptionalism here vis-a-vis the rest of the world in terms of the economy. How unusual is that, Francis, to have, I guess, the U.S. going one way, and the rest of the world going another?
Well, when I came up in the business, we would often be told the U.S. consumer is the most important thing globally because the U.S. economy is driven by the U.S. consumer. And in this case, there is one peculiar thing happening in this cycle that has contributed to U.S. exceptionalism, and that is that the manufacturing cycles and the services cycles are extremely disconnected. This was the 2023 recession mistake, which is that all of the manufacturing indicators suggested we were heading into a recession, and historically, the lag between manufacturing and services is very short, but it hasn't happened. So manufacturing exposed economies, they're really doing poorly right now. And in fact, they've done so poorly, they might be coming out of it. But services-based economies like the United States have had resilience. What is very different this time, and I think this has caught investors off guard, is that typically it's the Fed or the U.S. that leads the easing and hiking cycles. That didn't happen right now. Now it's actually emerging markets. So if you count out the amount of central banks that are easing right now, 1 in 4 global central banks is already cutting rates. The U.S., instead of being at the front of that pack, is probably going to be near the end of the pack. That's very different this time around.